Step 2, talk to a lender. If you're buying cash, you can skip this step, but if not, pay attention because getting pre-approved is an important part of the process. Now, before you start seeing homes, you need to know how much you can spend. The best way to do that is to get pre-qualified for a mortgage by speaking with a loan officer. The loan officer, otherwise known as the mortgage broker, is the person who secures the mortgage loan on your behalf. And it's very important to work with somebody trusted. So I recommend getting a referral. Now, after you have your initial conversation with the loan officer, he will most likely ask that you fill out a pre-approval application, which will include your income, credit history, and your current assets. Now, depending on your situation, you may decide to run your credit, but don't worry, that's not required. And if you're not ready, that's okay too. You can hold off on providing those documents. Now, if you do want to move forward, the documents you'll need are pay stubs, bank statements, and tax returns. Be prepared to share more financial information with this person than anyone else. Now, once the lender receives all of the requested documents, they will review it, calculate your income, they will match you to a loan product that's right for you. Now, things to look out for. You need enough assets that are sourceable for the down payment, enough assets for the closing costs, gift funds for family members are okay, income, employment history, credit score, credit history, things like that. Now, there are many different types of loans, but generally speaking, the better your credit history and the more money you can put down towards that payment, that down payment, the better off your terms will be. Now, let's break down the different types of loans. There's FHA versus conventional. While not the only options, these two options are the most popular choices. FHA is another word for government-backed loans. Now, with their more flexible lending requirements, FHA loans are well suited for first-time homebuyers, particularly because those with lower credit scores may be accepted. On the other hand, conventional loans may be ideal for borrowers with higher credit scores who could also make a larger down payment. Now, let's talk about the benefits of an FHA loan. FHA loans typically don't require a big down payment. You can put down as little as 3.5%. And if you've had credit problems such as a foreclosure or a bankruptcy, FHA loans have a shorter waiting period to qualify for new credit. Now, if necessary, you can enlist another borrower, such as a relative, to help you qualify for the loan. Okay, let's talk about things to consider with FHA loans. Your interest rate may be lower as compared to a conventional loan or conventional mortgage, but FHA loans do require their borrowers to pay mortgage insurance premiums, and those are paid up front. This is 1.75% of your loan amount paid in a premium to FHA. FHA loans can be used only for primary residences, not for second homes or investment properties. And they do have maximum loan amounts that vary state by state and by county. Now let's talk about the benefits of a conventional loan. Conventional mortgage loans usually require less documentation than FHA loans. And that may speed up the overall process and the processing time. Now, with a down payment of 20% or more, you will not be required to have mortgage insurance, which will reduce your monthly payment. Unlike FHA loans, you can use a conventional loan to purchase a second home or an investment property. If you're considering a property that's more expensive than an FHA loan limit, a so-called jumbo loan can be obtained, and that can be obtained through a conventional loan product. That will be your best option. Now, things to consider about conventional loans. You'll need to make a down payment of at least 5%. And if you put down less than 20%, you may be required to carry that mortgage insurance. For a conventional loan, you are more likely to get a favorable rate if you have an excellent credit record and a high FICO score. Since the loan isn't insured, a lender may want to make sure that you have adequate income to support the loan and you aren't burdened by a lot of other debt. Like an FHA loan, you can enlist another borrower, such as a relative, who can help you qualify. Your loan officer will give you an idea of how much you can spend on a home. He'll also give you a list of closing costs, so you know what to expect. which can be anywhere between 3 to 5% of the purchase price. Let me give you an example. If you're buying a home for $500,000 with a conventional loan product and you're putting 20% down, your numbers are going to look like this. $500,000 is your purchase price, $100,000 is your down payment, and you can expect around $15,000 in closing costs. Now, to give you a better idea of your closing costs, you can look at page 3 of the Florida Purchase Agreement, and that will list all of the things that you are responsible to pay for. As the responsible, this list includes taxes and recording fees on any notes or mortgages, recording fees for the deed and for the debt financing statement, your owner's title policy, your owner's survey if it's required, your lender's title policy and endorsements, any HOA or condo association application fees, any transfer fees, a municipal lien search, any loan costs such as appraisal fees, any inspections, any attorney fees if you have one, and any property-related insurance. Now, I'll go into this further when we go to step 4. We talk about making an offer. But one thing I want you to remember, your loan officer is not your financial planner. It's up to you to decide how much you want to spend in total and how much you would want to put down towards your down payment. Now, keep in mind, you don't have to be ready or have everything perfect in order to have that initial conversation with your loan officer. It's an important conversation to have so that you can best prepare for that process of purchasing a home, and so you know what to do. Now, once you've provided all the documents to the loan officer, in a day or so, you'll receive what's called your pre-approval letter. You'll need this, and this will go over all the terms of your pre-approval. You'll go over this with your lender and with the realtor. And the reason why this letter is so important, because pre-approvals are based on the monthly payment, and this is going to vary based on each specific property. They may have different tax amounts owed, different amounts of association fees, and your lender is going to help you understand, you and your realtor understand what your price point is and how much you can afford in monthly taxes and monthly insurance based on the specifics of a certain property. Now, your pre-approval letter is also important because it tells the seller that you are qualified for that purchase. Without this, a seller is not going to agree to sell their home to you. Now, let's take it back for a second. What if your credit isn't as good as you thought? Or what if this conversation helps you realize how much more you need to save in order to get the house that you want and afford the correct home for you and your family? It's okay. There may be an arbitrary amount that you can use to pay down a debt, and that will increase your credit score. The lender will give you those details so you know how much to save and what you can pay down on what credit card. It may even make sense for you to work with a credit repair company. Either way, speaking with a qualified and recommended lender is critical to the process if you're going to get a loan to purchase your home. Now that we've completed step 1, talking to a realtor, and on to the most fun, which is step 3, shopping for your home.